So let's start off by quickly recapping what we talked about on Tuesday. Okay? So on Tuesday, we tried to set up a general framework for the subject, to give you an idea, an impression of what managerial accounting does, what managerial accountants do with an organization, and how that fits in, how that interlocks with what financial accountants do. Okay? Now, someone summarize to us, to the rest of the class, what the financial accounting system does. Very briefly, in your own few words. What kind of information does it produce? Who's the information intended for? And what is the purpose of the information? The financial accounting system. In your own words. And who does it report to? Who are the intended users of the information? People on the outside of the company, right? That's exactly right. So financial accounting system describes or summarizes the financial performance of the company. By that we mean performance translated into dollar metrics, right? Into various types of dollar metrics, profits, net worth, retained earnings, and so on, but all dollar metrics. And this is intended to help people on the outside of the company form an assessment of how the company is performing. So people outside of the company could be investors, who in turn could be of two types. They could be stockholders or the other type of investor, creditors, right? Creditors or lenders or debt holders. The IRS, the SEC, various branches of the government, people that interact with the business on a daily basis, like customers, suppliers, competitors, and so on, help all of them form a picture, form an assessment and evaluation of how the company is doing. So financial accounting performs largely a communication role. It's a communication device. Okay. Now, in contrast to financial accounting, what is the managerial accounting system designed to do? To assist who in decision making? Does anyone want to add to that? To assist internal stakeholders in decision making. Okay, so in this, the managerial and financial accounting are really complementary. They don't do the same function. They do very distinctive, very different functions. So if you want to draw a map of all the stakeholders, there are many stakeholders that are external to the firm. These are people who have an independent economic existence of the firm, like stockholders, the government, the community, competitors, customers, suppliers, and so on. These are all external stakeholders. Financial accounting is intended for them. Okay? Now that leaves us with the internal stakeholders. The internal stakeholders are people that actually function within the company, that compose the company itself. Any organization, any corporation, any enterprise at the end of the day is just a collection of people who are organized into in some sort of hierarchy, right? So the managerial accounting system is designed to help the people inside of the company, primarily employees or managers, as we sometimes refer to them, to make decisions that support activity and strategy at all levels within the company. So really financial accounting and managerial accounting fit together like two pieces of a puzzle. The financial accountant takes the results of the company as they are after they've been generated and then translates them into debits and credits, into dollars, and puts and presents them in a form that makes it easy for people outside to understand what's going on. That's what the financial accountant does. The managerial accountant, on the other hand, there's a more primitive role in the company itself. The managerial accountant provides the information that helps managers within the company to make the decisions that in turn generate the results that the financial accountant is trying to describe. You understand how these two roles interact. Right? So the managerial accountant in one sense performs a more primitive role because the financial accountant would not have anything to record or would not have anything to describe unless the decisions get made in a particular way in the first. Okay, so they fit together in a very complementary way. Each group needs the other group in order to carry on its functions. So now, let's extend that idea a little bit and just keep talking in general terms a little bit more about the distinction between financial and managerial. So the financial accountant's role, I alluded to this last class, is largely a historical role. Right? So many people describe financial accounting as an exercise in accounting history. You're describing economic transactions that have already happened, that have happened in the past. You're describing them in a particular way, using the rules of debit and credit that people have come up with. Okay, so the financial accountant takes the results, the performance, the strategy, all of that as a given, and then translates that into a particular language, into the language of debit and credit. But the managerial accountant actually plays a much more strategic role. The information that the managerial accountant provides, the kind of information, the quality of information, the way in which he presents that information can actually influence the decisions that get made. Because if you present information perhaps in one form as opposed to another, that might influence the actual decision that gets made, the actual strategy that gets chosen. Okay? So financial accountants simply describe what has already happened, but the managerial accountant has the ability to affect what's going on itself. So it's a little bit more of a fundamental role within the company. And this is what your textbook, if you've already looked at it, means when it says that the managerial accountant plays an important part in formulating strategy. Okay? Now you all know the term strategy, right? So what does it mean in a corporate sense? It's an English word. We use it in conversation, right? What does it mean in a corporate sense?
Strategy in corporate sense?
Yes. In your own words.
Utilizing the workforce
Mm-hmm.
to reach a specific goal.
Absolutely. Very, very good. It's a very good definition, right? Leveraging your strengths, whatever it is that you are able to do, in the best possible way in order to achieve your goals. Right? So a strategy is just a series of steps as to how you plan to get from where you are to where you want to be. Right? So in a corporate sense, it means very much the same thing as what it means when we use it in a conversational sense. So the managerial, when you think about a strategy and really go deep into what a strategy means, a strategy is nothing but a series of interlinked decisions. Right? Because a strategy is just a plan as to how to achieve a particular objective, and the plan just consists of a series of very small decisions that are linked together in some natural order or sequence. So the managerial accountant, by providing information that supports each of these decisions at the point at which they get made, is really playing a fundamental role in generating strategy. So just for us to understand this a little bit better, we want to talk about the kinds of strategies that exist. Okay? Now many of you may or may not have taken a strategy class until now. But there are two generic strategies that all corporations are following, inherently, implicitly, maybe consciously or unconsciously. Okay? And don't interpret this too literally when I say there are two generic strategies that all corporations are following. Any given corporation at any point in time might sometimes be using some kind of mix of these two strategies. But if you look at it, it will always be closer to one end, to one particular type of strategy than to the other. Okay? And here are the two generic strategies. So the first generic strategy is what we refer to as cost or competition. Okay, and this is all in your notes, so if you just want to look at your notes, that's fine. If you want to make notes, that's also good. So a cost or price competition strategy is really the simplest in a technical sense. Okay, so this is where you do the following. You provide a very standard product or service. And what do I mean by standard product or service? Something that's already out there on the market. Okay, you replicate that. You provide something similar to what's already on the market. How can you make money by providing something similar to what's already on the market? You have to have something that distinguishes you from everyone else, right? Some kind of unique selling proposition. You provide a standard product, but you provide it at a lower price than your competition. Okay, so that's what we mean by very generic price competition. Now, if you want to provide the same product that your competitors are providing, don't take me too literally when I say the same product. By same, I mean something that's broadly similar, okay? Might not be identical in every single aspect of its design. Now, if you want to provide a similar product to what's already out there, provide it at a lower price, and still continue to make a profit, what do you need to be able to do first? You need to be able to make that product or service at a lower cost, right, than your competition. So that's why this strategy is referred to either as cost competition or as price competition. Okay, so providing a standard product or service but doing it at a lower price, which necessarily entails doing it at a lower, producing it at a lower cost. So that's sort of one end of the strategy spectrum. Now, all the way at the other end of the strategy spectrum, and you should be able to think of examples of corporations at either end very soon. At the other end of the strategy spectrum is something that looks completely different. You provide not a standard product, but something completely unique, something different, something specialized, something that's not currently available to customers right now. Okay? And how might you be able to do this? At the end of the day, it comes down to an idea. You have an idea that other people haven't had, or you're able to develop a technology that other people don't have, so that enables you to produce something unique, something special. And because you are providing something unique, or something that doesn't exist on the market right now, you will naturally, at least for a certain period of time, be able to get away charging a higher price for it. Okay? So that kind of strategy we refer to as product differentiation, or a differentiated product strategy. And sort of the name makes it obvious what it is, right? You differentiate your product. Okay? You distinguish your product from everything else that's out there. So there are some other generic characteristics of each of these strategies that you should be aware of. So let's go back to cost or price competition. Okay? So an inherent part of the strategy is being able to produce at a lower cost than your competitors, right? So you need to get creative there. You need to be able to find some ways to push your costs down. But here's the thing. You're not going to be able to push your costs down indefinitely, right? You can't get them all the way down to zero. You still need to pay something for all your inputs, for your labor, for your materials, and so on. So there's a limit to the extent to which you can push your costs down always. Okay? So because of that limit, in a cost or price competition strategy, you're always only going to be able to make a few cents, a relatively low margin on each unit of the products that you sell. Okay, and what do I mean by margin? By margin, I just mean the difference between what you sell the product for and what it costs you to make it. Okay, so in the first kind of strategy, you're always going to make a relatively low margin because your costs can't keep going down indefinitely. Okay, there's a bottom that they hit, and then after that it's going to be difficult for you to push your costs down below that. So you tend to make a relatively low margin on every unit that you sell. So if you want to make a lot of profit, what do you need to do? You need to sell a lot, right? So this is what we refer to typically as a high volume, low margin kind of strategy. Okay, and these are sort of colloquial business terminology or vocabulary that you should get familiar with, start using and start thinking in terms of. Now, product differentiation, some of you may already have figured out, is going to be the exact opposite of this. Because you are providing something unique, you will be able to get away with charging a high margin for it. Okay, because the product is unique. You have some kind of market power. You're not constrained by your competitors in terms of what you can charge. So you will be able to make a high margin by virtue of the fact that what you're selling is somewhat specialized. It's not going to appeal to everybody, right? It's only going to appeal to a relatively small segment of the market. So you will necessarily be a little bit lower volume. Okay, so the first kind of strategy will typically give you low margin, high volume companies, and the second kind of strategy will give you lower volume but higher margin companies. Okay, so it's a very useful exercise for you to start thinking of any enterprise that you encounter in these terms. Anytime you encounter a business There's something that you're analyzing for financial accounting course, or something that you encounter in your personal life. You walk into a restaurant, or you walk into a supermarket. You should start asking yourself these things. Okay, what end of the strategy spectrum is this enterprise inherently adhering to? Okay, because it's a very useful way of characterizing firms. So now here's an exercise for you to do right now. I want you all to think of some industry. Okay, pick an industry that you know, that you're familiar with, that you've interacted with, and then give me the names of two competitors within that industry, one of whom is on one end of the strategy spectrum and the other is on the other end of the strategy spectrum. Okay, take a few seconds to think about it. You will understand the question, right? Think of any one particular industry and give me the names of two competitors within that industry, one of whom is on the cost competition end of the spectrum and the other on the product differentiation. I'm sorry, I didn't get the first couple of words. Honda, okay. Yes, that's a very good example. Right, everyone heard both examples. Any other examples from maybe the consumer goods industry? Old Navy against Prada, right, or any of the other luxury manufacturers is a very good example. Any other examples? I want to say yes, because Apple is clearly a product differentiator, right? It's sort of the ultimate example of a product differentiator. I don't know what Nokia does anymore. I mean, the firm is almost bankrupt, so. Yeah, so Nokia makes, I mean, you could make the argument that Nokia is sort of more of a high volume mass manufacturer of cell phones, yes. Absolutely right. The only issue with Apple is that now it's a little bit hard to identify what business it's in. Right? Is it a computer maker? Is it a phone maker? Is it an entertainment company? And so on. So Apple tends to be slippery in that way. A couple of examples that I always like to point out because they're so classic. One is Dunkin' Donuts as opposed to Starbucks. Right? So that's a classic example. And the other one is Walmart in the consumer retail industry as opposed to Trader Joe's or Whole Foods. Okay? In fact, Walmart, just like Apple is the classic product differentiator, Walmart is the classic cost competitor. Okay, you can buy anything at Walmart for a lower price, for a cheaper price. Right? They are the classic cost competitor. In fact, many strategists even believe that they invented the idea of cost competition. Or maybe that's too much. That's putting too much on it. They developed techniques to reduce costs that nobody had successfully implemented before. Okay. So now that we're on that topic, does anyone know anything? Just a little bit of a detour that I'd like to take. Does anyone know anything about why or how Walmart's costs are so low? What enables it to make money while charging such a low price? Very good. Yeah. A lot of us tend to, yes. It's somewhat similar to what the gentleman was talking about, right? So actually they're both absolutely right. So many people we all tend to think that the reason they're able to keep costs low is because they buy in bulk. That's one part of it, but that's not the large part of it. The large part of it is the way in which they manage their working capital, their inventory, their receivables, and their payables. So the first thing that they do is they do just-in-time inventory. Right, so they have their ordering and their reordering and their replenishment system so finely tuned that they're able to order inventory exactly as and when needed. Okay, so they don't buy extra stock and waste money holding it in godowns or in warehouses even for a day longer than necessary. They're tying up their money for as short of a period of time as possible in inventory. They don't have any accounts receivable, And why do they not have accounts receivable? Because most of their customers pay, cash, right? Don't get to pay credit. And then the last thing that's left in working capital is your accounts payable. Accounts payable is what you owe to your suppliers for the material that you buy from them, the inventory that you buy from them. And Walmart, by virtue of being such a large customer, is able to extract the best credit terms on the market. Now, if you and I went into business, we would have to pay our suppliers usually in 30 or 60 days, but Walmart is able to pay them in something closer to 200 days. Okay, so it's able to get its suppliers really to finance its entire operation practically free of cost. Okay, so the reason why we talk about these strategies is because you realize that the distinction between these two strategies is inherently related to cost, right? So the kind of product that you make and the way in which your cost structure is built up. The managerial accountant is very much involved at every stage of strategy making, the point at which you're formulating your strategy, the point at which you implement your strategies, and the point at which you're monitoring your strategy. Now, suppose you want to pick, you're trying to go into business, and you want to pick which end of the spectrum you want to be on. It's never really a conscious choice. You usually have something that you're good at. You're either good at making things efficiently, in which case you go to this, or you're good at coming up with new ideas, in which case you go to the latter one, right? But the managerial accountant is the one who gives you the information that helps you identify what it is that you're good at. Now, if you want to be a cost competitor or a price competitor, you realize it's really, really important to be able to measure your costs as accurately as possible, right? Because your margin is in cents. You need to be able to figure out exactly how much it's costing you to sell one sachet of shampoo or to serve one cup of coffee or to make one cheeseburger, and your calculations can't be off even by 5 cents, because that 5 cents could be your entire margin. Okay? Whereas if you want to be a product differentiator, then you need to understand different things about your costs. Your main costs are going to be things like research and development and trying to develop your new products. You need to understand what the productivity of your R&D team is, how good you are at at implementing different kinds of ideas and so on. So that's where you where you develop your strategy. And then comes the part in which you implement your strategy. Suppose you decide you want to be a cost competitor. The first thing you're going to do is to try to go out there and figure out, okay, what are the different ways in which I can reduce my costs? Right? And then at every point you're going to be faced with different alternatives. Should I have more people manually doing the stuff, or should I replace the people with machines? Each alternative is going to come with its own costs and benefits. Okay, so the managerial accountant gets involved at that point. And then finally, once you develop a strategy and implement it, then comes the most important part, which is monitoring your strategy. Okay, so one of the common mistakes that we make when we think about plans is that we think that we make the plans and then we laminate them and hang them up on the wall and forget about them. No. Okay, the most important use of having a plan in place comes in after you have implemented it. Because once you've implemented a plan, then your actual results start coming in, right? And then what do? You take your actual results and you compare them to the plan. That's the reason you make a plan in the first place, right? And when you compare your actual results to the plan, well, naturally, are the two going to coincide exactly? No, rarely, right? Even if they do, it's probably a fluke. There are going to be differences. And then what do you do at that point? You analyze the reasons for the differences and you try to figure out ways to correct them. So these are all different things that the managerial accounting does, and each of these different stages that I just spelled out for you is going to be a separate topic that we deal with in this class. Okay? So really the bottom line that I want you to take away is that the whole subject is very much at the heart of strategy formulation, and that's one of the reasons why it's related to every single business discipline. Okay? So let's have you all turn to page 5 now. Did you see that diagram? So this is a really important diagram. This is the first really exercise that we're going to do in cost classification. Okay, in understanding different types of costs and then trying to classify costs into one of the different types. So basically what we spend the next 2 weeks doing is understanding what a cost means and then looking at various different ways of looking at costs. And this is the first dimension along which we look at costs. Okay, and this is what strategists like to call the value chain. It's just a pictorial representation of how an organization creates value, or creates something that the customer at the end is willing to pay for. Okay, and the most common way in which we describe costs or classify costs is based on what part of the value chain they come from. Okay, so you're going to hear me talking, and you are also going to start in a few days talking about production costs as opposed to design costs, R&D costs, customer service costs, distribution costs, and you need to understand exactly what the distinctions between these different types of costs are. Okay, so let's look at the diagram of the value chain. If you can't see it up here, you can just look at it on your notes. So the value chain is a map, is a mental map of the various functions that have to happen in any organization to some extent or the other in order to deliver something that's of value. Okay. Now, not all organizations are going to have all of these building blocks, the value chain, but most of them will have these. So, at the very top of the value chain is the activity that we call research and development. Okay. What comes next is design, and then that's followed by production, which is followed by marketing, distribution, and finally customer service. Okay. So let's talk a little bit about each of these functions in the value chain. So the very first one is research and development. Now most of us think we understand what happens in research and development departments. I have two questions for you. The first one, what is the difference between research and development? Because that's essential to understanding what the R&D department does. Okay. Very good. So let me just repeat what you said so that everyone can hear it. The research part of the function is where you experiment around with new ideas to see what works, and the development part of it is where you take one and you try to move it further. There's some things that we want to add to this to make it more complete. The research function in any corporation is working on very fundamental, primitive, far-reaching ideas that may or may not have anything to do directly with what the corporation is selling right now, and which may or may not eventually generate any marketable products or services in the future. You heard what I said, right? It may or may not directly translate into any marketable products or services in the future. They're working on very far-reaching fundamental research. They're doing things that are not unlike what academics are doing in academic departments. Okay, so the research part of any organizational value chain is not intended at all points in time to be something that's a money maker. Okay, you could end up sinking several millions of dollars into a research project that lasts 20 years and goes nowhere, because that's the nature of fundamental research. It's very risky. You really don't know when you undertake a new investigation whether it's going to amount to anything or not, but you need to do that exploration in order to find out. So just to give you a taste, with some real examples, if you look at Apple, for example, or Microsoft, the researchers at Microsoft Research or IBM Research are working on very fundamental problems that have really nothing to do with improving Windows or improving Vista or anything like that. They are trying to do things that relate to, say, artificial intelligence, and getting computers to recognize voices, to understand human speech, robotics, and so on. Okay, now the development wings, what they do is once an idea has come out of the research wing that has some marketable value, that you think there's a glimmering of the fact that there may be a product in there, and the development wing takes over and actually tries to make it into something that customers might want to buy. Okay, a better example is really from the pharmaceutical industry. Okay, now not all industries do R&D. There's only a few industries that do R&D. Now if you were a supermarket chain, you don't have a big R&D. department. Okay, the few industries that do R&D are technology primarily, right? Entertainment, and then pharmaceuticals and biotech. Those are the ones where you get the most amount of R&D. So in most of these large drug companies, most of the largest drug companies in the world are American. Most of them, the researchers are working on things like figuring out how to reverse the aging process, not in human beings, even in mice. Okay, and then once every 25 years, they'll come up with something that has marketable value, some molecule that they tried, that they intended to be used for reversing the aging process, but which they realize actually ends up helping to lower cholesterol. Okay, that's how discovery works most of the time. And so then the development department takes it and then actually does the process of converting it into a stable molecule, figuring out how to put it into pill form or capsule form or injections, testing it out on people, doing the drug trials and so on. That's what the development people are doing. Okay, so I hope you understand now exactly what the R&D division does. Now once you have a product, once you have a notion for a product, then the design people take over. They actually design the physical product. Okay, not only do they design the physical product and test, usually have to test many prototypes, right? They also design the apparatus that's going to make the product. Okay, production, you all understand what that means. It's the act of actually combining together all the physical inputs you need in order to create the tangible product. Okay, happens on a factory floor in a very large scale mechanized environment most of the time. Marketing, also we're familiar with. It's the process of getting customers to know about your product and getting them interested in buying your product. Okay? Distribution is where you actually physically get the product from the place where it's made to a place where customers are able to access it. Now, any large corporation will typically have many distribution channels. Right? So if we look at a company like Apple, like iPhones, iPads, computers, there are many distribution channels. They have an online distribution channel, right? You can go online and you can see the product and you can buy it. They have retail stores. They have other third-party vendor stores like AT&T, Verizon, and so on. So they have a multiplicity of distribution channels always. And then finally, customer service. We all know what customer service is. Okay? So which part of the value chain is most important? I've heard marketing, I've heard R&D, production. So you understand the reason why it's a chain now, because it's all interlinked, right? And every part of the chain really needs to function, and it's difficult to pick out one part of the chain as being more important than the other. But in general, the ones that are upstream, right, higher up, tend to be more fundamental, in that if something goes wrong in the design stage, for example, well then you have issues at all the other parts of the chain. Okay, so that's one thing that you want to keep in mind. So let's do our first cost classification exercise. Okay? So I put an example here. This is an example from the textbook. So let's go through each of these costs and let's classify them depending on the part of the value chain that they come out of. And at the end of this exercise, you should be very comfortable in thinking about costs as being from any given part of the value chain. Okay, so this is compact computer. Okay, and the first cost we want to look at is electricity costs for the plant that's assembling the Presario line of computer products. Okay, what part of the value chain is this cost coming from? The production cost, right? Production costs are also often referred to as manufacturing costs. You hear me using that term actually more than production costs. You want to make a note. Production costs, manufacturing costs, the same thing. Okay, transportation costs for shipping Presario computers to a retail chain. So distribution costs, right? Payment to David Kelly Designs for design of the Armada notebook. It has the word design in there twice, so it's clearly a design cost. The salary of the computer scientist is working on the next generation of mini computers. It could be a research and development cost, right? We really don't have enough information to figure out if this is an R&D cost or a design cost, but it comes from that general area. Okay, the next one is interesting. The cost of Compaq employees' visits to a major customer to demonstrate Compaq's ability to interface with other computers. Most of you think this is a marketing cost? It could be a marketing cost or a customer service cost. Right? It really depends on how you look at it. So if you're doing this in order to get that guy to buy more compact products, then it's clearly a marketing cost. If you're doing this as a follow-up service to someone who's already purchased from you, then it's a customer service cost. So sometimes the distinction is not as clear. The purchase of competitors' products for testing against potential compact products. I heard research and development. I know this is not a research and development cost. It's more a design cost because you see, there are existing products already out there. So you see the distinction. There are existing products out there, so this is clearly not an R&D item. It's more of a design item. Okay. It could also be a marketing expense if you want to run an ad, like the PC versus Mac ads. We say, oh, like the Windows OS takes 10 seconds to open up, whereas the Mac OS only takes 1.5. Okay. A payment to a TV network for running compact advertisements. This is the marketing cost. And the last one, the cost of cables purchased from outside suppliers to be used with compact printers. The production or a manufacturing cost. Okay? So generally things that are related to physical inputs that actually go into making the product, like the material, the labor, and other costs that are incurred in the environment around it, like electricity and so on, all tend to be production or manufacturing costs. Okay, so now I hope you're comfortable with this terminology. Okay, so we're going to start using this very frequently in order to describe products. Now, the very last thing, there's a couple of things that we don't talk about. We haven't talked about everything that's on the handouts. The things that I don't talk about in class, you want to make sure that you go home and then you read. The reason we skip them sometimes is because they're self-explanatory. Okay. So the very last thing I want to talk about is exactly about 30 minutes is professional ethics for managerial accountants. Okay? So the topic of professional ethics is largely an accounting topic. It's something that pervades all of accounting, financial or managerial, but it's so important that we want to devote a little bit of time to discussing it. Now, before we get into what ethics are in this context, I want to talk about that description, professional ethics. Okay, so you all understand that accounting is when you become an accountant, you're considered a professional. Okay, now who can tell me exactly what that means? In your own words, there are many different aspects to being a professional. So you may want to touch on one or the other. Who can tell me what it means to belong to a profession? So there's some specialized skill that not everyone possesses, and in order to practice that skill legitimately, you need to be certified or licensed, right? Or allowed to do that by who? By what? Who does the certifying? You can be certified by university. Your diploma certificate, your BA, that entitle you to practice the profession. You typically need to be certified or licensed by a special board, a special body that's set up to certify people. And once you are certified or licensed, then you're admitted into the profession. Okay, and typically that body that does the certification has monopoly powers over certifying. It is the only body in that country or in that jurisdiction that's allowed to certify. Okay, so suppose 4 years down the road, 3 years down the road, you're all going to graduate, many of you with a BA in accounting or a BSc in accounting, right? So that makes you an accountant. But at what point do you become a professional accountant? When you pass the CPA exam and you are admitted into the American Institute of Certified Professional Accountants. Okay, so similar distinctions exist for everything we consider a profession. When you come out of a law school and you take a JD, you are a lawyer, but you are not admitted to the profession unless you take the bar and you're accepted into the bar. So similarly for doctors, it's not sufficient that you have an MD. You have to be licensed by the medical board of the state in which you want to practice. Okay, so now being admitted to this body of professionals gives you some exclusive rights. Okay, that people on the outside don't have. So as a doctor, you can prescribe. As a lawyer, you're allowed to argue. You're allowed to appear before the court. As an accountant, you're allowed to sign off on financial statements of other companies. It's an exclusive right that you get. Now, in return for that exclusive right, you need to adhere to a bunch of rules and regulations. Now, the fundamental thing that you need to do, you need to adhere to a code of conduct. Okay, this code of conduct is akin to the laws that surround that profession. If you're found to be in violation of that code of conduct, you can be disallowed from practicing. Okay, and the second thing you need to do, which is equally important, is competence requirements. It's not sufficient you just sit for the CPA exams once and then you forget about it afterwards. You need to take a certain amount of credits every year. Okay, so they're called continuing professional education credits you want to take, and you need to keep up if you want to retain your license. Okay, so these are the things that go along with being in a profession. So typically we think only of financial accountants as being professionals, right? Because the CPA exam is a financial accounting exam. But managerial accountants belong to a profession also, the Institute of Management Accountants, the IMA. Okay, so just like the CPA exams, there's a series of IMA exams that you could also appear for if you wanted to be a certified managerial accountant, and you would want to certify for the same reasons that you want to certify as a CPA. Okay, it just allows you to do certain things that uncertified experts are not allowed to do, and it increases your possibilities of getting a job. So later on in the semester, we will have someone from the IMA come and talk to you guys about the IMA exams. Okay, in case any of you might be interested many years down the road. So that's why we call these professional ethics. Okay, because they're not only founded on basic principles of fairness and justice, but also explicitly codified into a code that's given to you by your profession. So they're akin to the law as far as you're concerned. Okay, and there are a few basic elements in the code. Competence, we talked about that relates to the continuing education. Confidentiality, integrity, objectivity, we all understand what these terms mean, right? In a very instinctive way, even if you don't understand the dictionary definition. So you can't understand ethics by talking about them, by describing them. Okay, that's a useless exercise. So what we are going to do now is a group discussion exercise. Okay, I'm going to present you with a situation where there are a number of ethically shady questions in front of you, and you are going to put yourselves in the shoes of the accountant who is obligated with signing off or not signing off on each of those transactions. Okay, some of which are ethically questionable. Okay, and I want you to discuss amongst yourselves and decide whether you are comfortable, based on some fundamental instincts that I know we all possess, whether you are comfortable with signing off on those transactions or not. Okay, everyone understands? So you can basically just work together with the people that are sitting next to you. Okay, just for 2 or 3 people. Before you start, I want to introduce you to the situation. Okay, so this is Janet Taylor. Okay, so you guys are all Janet Taylor. Okay, you know, the new division controller of the snack food division of Gourmet Foods. Now, what does the word controller mean? Has anyone heard it? Controller simply means chief accountant. Okay. So Gourmet Foods has reported a minimum 15% growth in annual earnings for each of the past 5 years. The snack foods division has reported about 20% annual growth in earnings for that period. So we've grown at more than the company average. Okay, so we've been a star performer. Now, during the current year, the economy went into a recession. The corporate controller estimates a 10% annual growth rate for Gourmet Foods this year. So our growth rate is going to drop. 1 month before the fiscal year end, the current year, the fiscal year end is December 31st. Taylor reports that the snack food division will report only an 8% annual earnings growth. So we're going to grow a little bit less than the corporate average. Okay. Warren Ryan, the president of the snack food division, is not happy, but he notes that certain end-of-year actions still need to be taken. Why do you think the end-of-year actions is in quotes? It will sort of become obvious as you go through. It's in quotes because it's a euphemism for something else. Okay? It's a euphemistic term. So it needs to be taken. Taylor makes some enquiries and compiles the following list of end-of-year actions that were more or less accepted by the previous controller. Okay? So there's 7 or 8 actions there. 1, 2, 3, 4, 5, 6, 7. So what I would like you to do is ignore there are some requirements at the bottom. Now ignore those requirements. What I would like you to do is is discuss each of these 7 one by one, okay, with the people sitting around you. You can make little groups of 2 or 3. You can walk around to find someone else if that's what you'd like to do. Just find a couple of people to discuss. Go through each of these actions one by one and decide as a group. And really, don't look at this from the perspective of somebody else signing off on those actions. Decide as a group whether you would sign off on those actions or not. That's when issues like this really start generating some thought in your mind. Okay, so everyone understands what they have to do? Okay, so you guys decide. We can take about 10 minutes, and then we'll come back and we'll discuss. Sorry? I don't have any more.
You don't have any more?
You'll just have to look at it on this. Sorry?
So we should pick one of them? Or?
No. You go through each of them and you decide whether you would be comfortable authorizing each of these transactions or not.
Okay, got it.
You understand? You go through each of them and you say, yes, I would, no, I wouldn't, yes, I would, no, I wouldn't.
Okay.
Okay.
I didn't bring the photocomic paper. Can I bring it on Tuesday?
Mm-hmm.
Thank you. I forgot. I completely forgot. Thank you.
guys are done? What do you not get about it? No, that's not what it says. So it's deferring December's routine monthly maintenance. So what payments is not in there. So it basically means not to do the repair and maintenance work in December, but to postpone that to January. That's what it means. It's not an issue of the payment. It's an issue of whether you actually do the maintenance or not. You want to move it out of December into January, and for obvious reasons. That's why the expense is recorded in January as opposed to in December. Okay.
After the class, if you can do this job just in the content class.
Okay. 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 I can ask them. Yeah. But what are they going to be given? Oh, they get $500. I see.
They have to record
Every. I see. And you will give them some training?
Yes.
You'll give them some training, right? Because. Oh. Okay, take 2 more minutes. Wrap up and come to a conclusion on everything. Well, looks like most of you are done. Are you guys done? Okay. Let's look at the first one. Okay. Deferring December's routine monthly maintenance on packaging equipment by an independent contractor until January of next year. So let's make sure we understand what this means. You typically do an monthly maintenance, repair and maintenance work on all your machines. You decide not to do it in December. Instead, you decide to push it to January. Why? So you record the expense next year as opposed to this year, and that will help you in pushing your earnings up this year. Now, does this sound acceptable to you or not? So can we have anyone, explain to us the basis for their position? Mm-hmm. So the point at which it would become unacceptable from an accounting perspective is if you did do the maintenance in December, but you somehow managed to find a way to delay recording the expense until January, because then your accounting statements are not a true and fair reflection of the actual economic transaction. So yes, I agree with you, and many people would agree with you. Let me ask you, give you a counterexample. Now suppose at the end of December, suppose there are some machines there where maintenance is very critical, like they're sort of very highly calibrated or something like that. And at the end of the month, like a piece comes loose and falls on an employee's head, and he dies. So would it be acceptable ex post now in light of the consequences? So the point I want to make is so every decision, so there's an accounting framework as far as that applies to each of these decisions. There's also an external framework of rules and regulations. You want to make sure you're not in violation of some kind of OSHA requirements. Those are occupational safety and health requirements that regulate the kind of environment you provide for your employees. That's a relatively minor point. The more important point is you'll hear this word when you take intermediate accounting classes, which is that it's a slippery slope to fraud. Okay? And here's what that means. So this year, you push the maintenance onto January. Okay? So this year, you're okay. You increase your earnings. So now, let's suppose we fast forward to next year. So next year, what are you going to need to do? You have to push, and not just push, you have to push a little bit more, because your standards are now going to be ratcheted up. Now next year you have to do at least as well as you made it seem that you did this year. Okay? So the standards that you're going to be held to are always going to keep getting ratcheted up. So what starts out looking like it could start out looking like a very innocuous action, but then before you know it, you end up in jail. Okay? Most of the large, you might think that this is an exaggeration, but it's absolutely not. Most of the really egregious frauds that we've seen in American history, like Enron and WorldCom, started out in this exact same fashion. Okay, with very, very simple. Now we tend to think that those sort of big historic events that happened must have been the result of very complex accounting manipulations. They weren't. They were really simple things like this. Okay, so yes, the vast majority of legal and accounting experts would agree with you, but you want to keep in mind that there are these other issues you want to be aware of that. Okay. Now B, extending the close of the current fiscal year beyond December 31 so that some sales of next year are included in the current year. Not acceptable. Explain to us. Okay. So could you find me the accounting rule or the part of GAAP that requires the accounting year to be 365 days? Okay, there is no rule. A fiscal year can be 10 months if you want it to be. It can be 13 months if you want it to be. Okay, so let me explain to you a little bit about the philosophy behind many of the things that we do in accounting. And some of you may like this and some of you may not like this. Unfortunately, that's the way it is. Okay? So particularly from the financial accounting standpoint, you can do many things that might seem inappropriate, but as long as they're reported and disclosed in a transparent way for all the investors to read and appreciate for themselves, there are many things that are not explicitly prevented by any code, by any accounting code. And this would be one of them. So you could have a fiscal year that starts on January 1st and ends on January 5th of the next year. Okay? As long as you disclose very clearly on top of the income statement for the 370 days started the 1st of January and ended on the 5th of January. There's no explicit rule in GAAP that prevents you from doing that. And in fact, you will see many firms that do this. That have fiscal years that are slightly longer than 365 days, and we don't completely understand why they do it. It's probably for the same reasons that are spelled out here. Now, so the presumption is that it's always the buyer beware, caveat emptor, right? You as an investor should make it your business to read exactly what's given to you and to incorporate the implications of what's given to you. So if you were a rational investor and you had a company that had a 13-month accounting year, you are expected to look at the profits number and to make whatever adjustments you think necessary in order to understand the company's actual performance. If you were comparing it to another firm that had a 12-month accounting year, for example, it's your business really to make that adjustment, to take out maybe 1/13 of what's reported or something. And so that's a general philosophy that pervades a lot of accounting. Okay? Now, the same issues that we talked about in A apply to this also. Now, this year's accounting year is 370 days. Then next year's accounting year has got to be longer, right? So the same issues that we applied, that we discussed in part A, apply to this also. It's always, the standards always keep getting ratcheted up. The first time you try to do something to manipulate earnings upwards, earnings are manipulated upwards in most cases, the next year you're going to be held to a higher standard, and so you're going to have to end up doing something even more. Question.
Are you able to do that on the fly? I mean, that has to be set at the beginning of the fiscal year. Can you do it in 11 months?
I'm not entirely sure, but as long as your external auditor signs off on it, I don't believe it's inappropriate. I think there would be a difference depending on the kind of company, the kind of scrutiny they're subjected to by the external auditors. But it would largely be something that has to be okayed by the external auditors. Apart from that, there's no explicit rule in GAAP. Sometimes, a lot of the times you'll see accounting years that are 366 or 367 days, and there are innocuous reasons for those extensions too. Like at the end of every year, you need to close your inventory. You need to shut down everything for a couple of days just in order to accurately assess how much inventory you have at the end of the year and so on. And sometimes, if the 31st of December is your most busy day, the day on which you get the most number of customers, you simply can't do that. Okay, so you have to delay closing the year by 2 or 3. So there are innocuous reasons also. So this is sort of a made-up example, just illustrated to help you think about that issue. I'm sorry, I have to repeat the question. I didn't understand. There's no violation of matching. Matching simply says you have to match with any revenues that you report the expenses that you incur in order to generate those revenues. So if you extend the accounting into 370 days, well, naturally you have more revenues, but you have more expenses also. So as long as you record the extra revenues and expenses faithfully, there's no violation of matching. Okay? Let's go to C, which is a little bit different. Altering dates of shipping documents of next January sales to record them as sales in December of the current year. Yes, this is fraud. Right, because there is an intention to. So how is this different from B? So if you did B, but then you reported on the financial statements that your fiscal year was only 365 days, well, that's fraud, right? Because you do one thing, but you report something else. So this is like B, because you're doing one kind of economic transaction, but you're just changing the reporting in order to make it seem as though it were a different kind of economic transaction. Okay? So anytime you intentionally do something in order to mislead or deceive, that's clearly illegal by the law as well as by GAAP. Okay? So this is fraud. It has to be approved by the, I think we went over this, it has to be approved by the external auditor, of course. And the auditors are going to, see, you're not going to see firms randomly changing their fiscal year around. Okay? Because there's a natural checks and balances on everything that you do that's imposed by the external auditor. So if for no apparent reason you increase your fiscal year by 15 days, that's not going to get past the external auditor. You have to have a very good reason. You have to be able to convince them first before you're even able to put it on your reported financials. But there are no, see, in the American, I don't want to spend too much time on this because we have many more items to discuss, but the general philosophy of the American model of corporate governance is that there are very few explicit rules and regulations that tell you do's and don'ts. Okay? Instead, we rely on parties that are put in place explicitly to monitor. So the external auditor, for example, is someone whose job is to monitor the accounting practices. And you're basically relying on the fact that the external auditor is going to do his job. Okay? Is going to impose on the firm what's reasonable and what's not. Okay? Okay. D, giving salespeople a double bonus to exceed December sales targets. You understand what this means, right? Suppose you normally promised your sales force 2% commission on sales. In December, you realize you're not going to meet your earnings target, so you promise them a 5% commission on sales. Okay. Mm-hmm. Yes, there's no ethical component to the decision at all. Actually, this is not an issue of accounting or ethics at all. It's just a business decision, right? As long as you record faithfully on your financial statements the increased cost of the commission, it might well be a good business decision for all you know. Okay, so there is no ethical component or flavor to this decision at all. Now, E, deferring the current period's advertising by reducing the number of television spots run in December and running more than planned in January of next year. Now, this is similar to which other situation that you saw? The very first one. It's identical to the first one. So again, what's the issue here? The issue is as long as you report faithfully the advertising expense that you incurred, any ads that you run in this year have got to be expensed in this year. Okay, so as long as you expense those ads and put it out there on the financial statements for all your investors to read and see for themselves, there's no issues of ethics or fraud. Let's come up here. Is it a good business decision? You don't know. It may or may not be. Chances are it may not be. Okay, because advertising is one of those expenses that's an investment for the future. It generates more customer interest in your products. So it may not be a good business decision after the fact that you don't know that. Okay, F is deferring the current period's reported advertising costs by having Gourmet Foods outside advertising agency delay billing advertisements until January of next year, or by having the agency alter invoices to conceal the December end date. So there's an or here, so there's really two different scenarios. So let's look at the last one first. By having the agency alter invoices to conceal the December date. This is clearly, it's fraudulent, it's like C. Okay, so it's clearly fraudulent because you're deliberately misinforming the people that are relying on your financial statements. Okay, you're pretending as though the economic substance of your transactions is not what you actually report to your investors. That's really wrong. But how about the previous one? Deferring the current period's advertising costs by having the advertising agency delay billing advertisements until January. So here's what that means. Suppose you ran your regular slate of advertisements in December and the advertisements have already aired. Okay? Now you're trying to persuade the ad agency to only send you the invoice for those ads in January, in the hope that by virtue of making them delay invoicing you, you don't have to report those expenses in this period. Okay, what do you guys have to say about that? So again, there's no illegality. So you overestimate the extent of the law. That's the question. Mm-hmm. Yeah, as long as you don't give them a bribe, for example. There's so is there anything on that? That's the question. Is there anything unethical on either part? Let's say. Yeah, as long as you agree in an arm's length transaction, you tell them, hey, look, for whatever reason you owe me a favor or whatever it is, as long as there's no under the table bribe or extortion or something like that, it's a business transaction. Okay, so it may seem like one party benefits exorbitantly, but it's a business transaction. So that part of it is okay, but here's the more important part. Can you defer the expense from December to January just because the agency sends you the invoice in January? So that's the objective. We want to be able to report this expense only in January. And we're trying to get the agency to invoice us in January so we can justify reporting the expense in January. That's the part that I want you to focus on, not the part where you get the agency to delay the invoice. So what's the issue there? So when is the ad meant to be expensed? Can you tell me the point in time at which that advertising cost becomes an expense for us, according to the principles of financial accounting? So when does the cost of that ad become an expense that ought to be reported on our books according to the principles of accounting that we learned last month? When you incur it. So any expense is meant to be reported at the point in time at which you incur it. And what does that mean? You incur an expense at that point in time at which the other party satisfies their obligations towards you, right? And in this case, unless we know more about it, but given the information that we have, that is satisfied the moment the ad is run. So the act of sending the bill or sending the invoice actually is irrelevant here. Okay, so really the point at which the ad is run, we're meant to report it as an expense. So no matter how we try to justify deferring that expense, that would not be an acceptable thing to do. So you understand the issue here. The issue here is really, it's a fundamental accounting issue as to when you incur the expense and when you're meant to report it. Now the last one, persuading your carriers to accept merchandise for shipment in December of the current year, although they would normally not have done so. So really, so this is suppose you're a car manufacturer and you're dealing with your dealerships, and you try to press more inventory on them so you can book those as sales. You try to persuade them one way or the other. So this would relate to what we touched on just now, right? It depends on how the persuasion happens. Now, if there's a bribe that's being paid, well, that clearly makes it unacceptable. But what if you go to your dealer and say, hey, look, I'm GM, I'm the largest car manufacturer in the business, and if you don't oblige me this once, I'm going to go to another dealer. Normally it's fine. Now suppose, yeah, by virtue of doing that, your power in the market increases so much so that you're able to kill all the other competition. Then there are agencies of the government that start monitoring what you do. So there are things like the Monopolies and Restrictive Trade Practices Act. Okay, but that's only when you're a monopoly, when you're the only player in a particular industry. And as long as that's not the case,